Welcome, everyone. We're seeing a lot of people change jobs nowadays, and it could be everything from people retiring, moving to a new company, or even just taking a temporary break from the workplace. Today, we're going to talk about things to consider when you decide what to do with your retirement account when you leave your job. A lot of people mistakenly think this is an easy choice, but that's rarely the case. Today, we're going to talk about what your options are and what to factor in so you can make the best decision for you and your family. My name is Marc Bautis. I'll be today's instructor. I'm the founder and owner of a fiduciary financial advising firm in Montclair, New Jersey. So let's get started today talking about the 6 options that you have with your plan funds. You can leave your employer plan assets in your existing company retirement plan, roll them over to your new company, roll the plan assets over into an IRA, take a lump sum distribution of your plan, or convert your plan assets to a Roth IRA, or make an in-plan Roth conversion of your plan assets. In some cases, you may be able to combine some of the options on this list. For example, you might decide to convert some of your plan's funds over to a Roth and roll the rest over to a traditional IRA. We'll evaluate all 6 of these options with respect to fees and expenses, control, investment options, access to your funds, and creditor protection. The first option, and the most straightforward of the possibilities, is to leave your retirement funds in your current plan. If you choose to do nothing, this is essentially what the option that you're taking. Some of the most common reasons people choose to leave their assets in their existing plan are to be able to utilize the plan-only 10% penalty exception if you take a distribution at age 55, the potential for lower fees and possibility of stronger creditor protection, that you might be able to get in a 401k plan that are not available elsewhere. Of course, these benefits also come with trade-offs, such as limited selection of investment options when compared to alternatives. And I just wanted to highlight a couple of things about the possible advantages that I mentioned. The plan-only exceptions to the early distribution penalty, it's called the age 55 exception. It allows certain individuals to take distributions from their retirement plan at age 55 or later, instead of having to wait to the normal retirement age of 59 and a half to avoid that 10% penalty. And one thing to note is that you still will have to pay tax on any distributions that you take. The second thing I mentioned is about potentially lower fees, and it really could go both ways. Some 401ks are horrendous with fees, and you're better off getting out of there as soon as you can. And then some are reasonable because you may be in a large plan and they may have mass scale and be able to negotiate lower fees with their providers. Actually, interesting, a TD Ameritrade survey found that just 27% of investors knew how much they paid in 401k fees, and 37% didn't even realize that they paid any fees at all. So, and part of the reason is that 401ks have a tendency to be hidden. But some of the fees that are typically included are administrative fees, investment fees, asset or revenue sharing fees, audit, fiduciary, consultant fees. So one of the things you want to do is you want to, first thing before making any decision is you want to see what type of fees you're paying. And you can do that by asking for a copy of a plan document called a 404A5 fee disclosure document. So that's probably the first place to start to figure out what you're paying in fees. Now, if you do leave it in your old company retirement plan, it could increase the possibility of having a zombie 401k. So this is a 401k that basically gets lost. And I see this numerous times every year with people. They had an old 401k that they lost track of or they forgot. And you would think, or it would seem like that this would be hard to do, but people change where they live, companies merge, and it winds up happening a lot more frequent than you would think. So sometimes it makes sense to move it solely just for the benefit of consolidation. Okay, so option number 2, if you go back to work for a new employer or have another old plan that you like, you may be able to roll your current plan funds to another plan. So plans do not have to allow you to roll over money from different plans into their funds. So it's something you may or may not be able to do. But if this sounds like it's something that appeals to you, you want to check with the new plan and see what the rules are. The reasons to why you would consider doing this, they're similar to the reasons that we just looked at in option 1 about leaving the money in your old plan. But just remember, when it comes to plans, the tax code is it's often more or far more liberal than the plan's own rules. So a lot of what we mentioned before, it varies plan to plan. So that's one of the things. There's your Department of Labor, your IRS rules, but then there's also what the plan allows. And sometimes different plans can put different restrictions on what you're allowed to do. So it really depends on, if your new plan is a good plan or not. But one of the things to consider with 401k plans is that your investment options, they're often limited. Usually you have like a menu of 10 or 20 options to invest in. And from that, you kind of have to build your 401k allocation out of that. Now, there's a lot of 401ks, or I think now it's all 401ks are required to have an investment option inside the 401k called a target date fund. So this is where you pick a fund with that has a year associated with it that's as close to possible as what you project to be your retirement year. And while this set it and forget it strategy, it's good for some people. There's a couple of things to consider with this. So one, it's an extra level of fun. So the way that the fund companies do this is they might have like the target date fund 2040. And inside the 2040 fund, they have an allocation. They have different funds that are attached to that 2040 fund. So what it does is it adds another level of funds, which means another level of fees in there. The average target date funds expense ratio in 2022, it's 0.62%, which is actually pretty high. And the investments, in this 2040 target date fund that we're talking about, they can vary from provider to provider. So you really want to see how the funds are allocated and if that makes sense for you specifically, not just everyone who's planning to retire in a certain year. So what it does is it really lumps everyone in there. However, there are worse things to do where, I've seen people just leave their entire 401k in cash for years. So things, the target date fund, things could be worse, but you may need or want a more personalized strategy than that. Third option is when you leave your plan, you can roll it over into an IRA. So this is a preferred option for many for a variety of reasons. If you want, you can roll your funds over to an existing IRA. If you don't have an IRA, you can move the funds over. You can create a new IRA and move the funds over. So some of the reasons that people do this are broader investment options. Like I mentioned in the 401ks, you're usually limited to that 10 to 20 options, whereas in an IRA, you almost can invest in anything. You can put together any kind of strategy you want, whether it's trying to hedge for inflation or, maybe you're trying to have more growth. The other things that you may get are simplification or consolidation if you take a couple or however many old 401ks you have and migrate them over into an IRA. And then there's also the opportunity to receive more personalized service. So some 401k plans do offer personalized service, but a lot of times you're dealing with a call center. But these benefits may come at the expense of other things. So there's potentially diminished creditor protection. It depends on what state and what the creditor issues are. You do lose that exception to the potential 10% penalty of being able to avoid that. And of course, in some cases, an IRA rollover can actually help lower your cost. So in some cases, it may be cheaper to have the funds in an IRA than they are in a 401k. Each situation is different, and really it just requires its own analysis to go through. All right, fourth option is taking a lump sum distribution. It's often referred to as cashing out your plan, or I've even heard it called the nuclear option. In general, it's not a great idea because you'll have to add the money you take out to your income for the year. So if you take a distribution of $100,000, it'll look like, and you have to pay tax on $100,000 of extra income in the year that you take it out. If you're under a certain age, let's say 59 and a half, you'll also owe a 10% penalty on top of it. And then, the other thing too that you have to consider is that you are saving this money for retirement in the hopes that one day you stop working and you can rebuild your paycheck using, an asset like a 401k. So you lose the tax deferral. And, the one thing to consider too is that while your money's inside a retirement account, you don't pay any tax on any of the interest, dividends, or capital gains. Whereas if the same funds were outside, you'd get that 1099 every year that shows any interest, dividends, capital gains, and you would owe tax on it. So, I say generally it's not a good idea to cash out your plan, but it's not always the case. If you're lucky enough to have the right set of circumstances, cashing out might make sense. That's because there are some certain tax breaks, like the tax break for net unrealized appreciation, that can offer savings, particularly if you have company stock in a retirement plan. So again, you want to always check and see what your options are, if you're eligible for any of them, before you make any decisions on what to do. Okay, fifth rollover option is a Roth IRA conversion. And again, this, like everything, this is not going to be the best option for everyone. It's one that everyone should at least consider, one that everyone has. In the way this works is in a Roth IRA conversion, funds go from your plan to a Roth IRA. And it's very important to understand this is a taxable event, meaning the amount you convert will be added to your tax return for the year. So the same way that if you take the distribution, it's added. If you do the conversion, the income gets added and you owe tax on it, but now you have it back in this in this other tax sheltered account, a Roth IRA. So let's look at an example. So let's say Jane has $100,000 in her regular 401k. She'd like to convert it to a Roth. And I'll talk a little bit more about why she might want to do that in a second. But if Jane moves forward with the Roth IRA conversion and converts that $100,000 plan balance, she'll have to add $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jane happens to be at. So you might ask, why on earth would anyone want to pay tax before they have to? And the answer is the benefits provided by the Roth IRA. So those benefits include no required minimum distributions, which I work with a lot of people that are not fans of. It's also the possibility of tax-free distributions in retirement. So there are definitely some benefits, whether you're getting the tax benefit up front or the tax benefit on the back end when you retire. I've talked a lot about this strategy in other webinars or other educational materials as part of something called filling up your tax bracket bucket. So that's a way to kind of leverage what tax bracket you're in. And some tax brackets are more appealing to do this than others. But it's a way to hedge against future tax rate increases in the future. Okay, sixth and final option is the in-plan Roth conversion. So this was only first allowed in starting in 2010. So it's not uncommon to see plans that haven't yet adopted this option. And if your plan doesn't allow it, you can't do it, even if it would make sense for you to do it. But the way an in-plan Roth conversion works, it's similar to the Roth IRA conversion in that you're generally taking pre-tax money, paying tax on it now in order to reap the tax-free rewards in retirement. The difference is that the conversion made from a traditional side of your company plan over to the Roth side of the plan. So it's still actually staying in the plan. And if you decide to make an in-plan Roth conversion, you're actually making two choices. You're deciding that a Roth conversion makes sense for you and that you're better off keeping your money in your plan than you would be moving it to a Roth IRA. So like all of our other options, this one has its unique set of drawbacks as well, but it's at least something to consider. Okay, so regardless of any of the options we discussed and which one you think is best for you, if you end up moving money out of your plan and over into another retirement plan, you want to make sure you complete the process correctly. As a mistake here, it can really be a big problem and cause a lot of pain. So in general, there are two ways that you can move retirement money from one plan to another. You can either move it indirectly, which is known as a 60-day rollover, or you can move it right from your plan to your new retirement account in what's known as a direct rollover. A direct rollover is generally the best way to move money. So let me just share a little bit of why that's the case. So in an indirect rollover, you receive a distribution of your plan's funds payable to you, or they are sent to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another retirement account. Now, 60 days may sound like a long time, but it can go by in what seems like a blink of the eye. So we get distracted, things happen, or we simply just forget about it. And then you miss that 60-day deadline and the distribution becomes taxable, and dependent upon your age, you may be subject to that 10% penalty. So even if you're on top of things and complete your rollover within the 60-day window, there's another problem with most indirect rollovers. When Congress created the plan distribution rules, they wanted to make sure people didn't take their money and run. So they created a special rule that requires plans to withhold 20% of taxable distributions that are payable to you when those distributions are eligible for a rollover. So again, let's just take that example we looked at of $100,000 that Jane's rolling over. If she goes the indirect way, she would only get $80,000, and the other $20,000 would be held for taxes. So Again, it's based on those two reasons of the tax withholding and having to meet the 60-day deadline, direct rollovers are usually the way to go. And the way a direct rollover works is your plan money is sent right from your plan to your new retirement account. There's no 60-day time limit to worry about. There's no mandatory 20% withholding. There's also no once per year rollover rule to be concerned with. So I guess the bottom line is moving money directly, it minimizes the possibilities that a costly error will occur. Sometimes plans won't offer to send money right directly to a new retirement account. In such cases, they're still required to allow you to make that direct rollover. So typically this is done by providing you with a check made payable to your new custodian. So for example, the check might read company X, which is the custodian, FBO, or for the benefit of your name IRA. And if the check is made payable to your new custodian like this, your distribution still qualifies as a direct rollover, and you still get that same favorable tax treatment. There's no 60-day deadline, no mandatory withholding. And that's true even if the plan sends the check directly to you and has you forward it over to your new custodian. Okay, so that's it for today. I want to thank everyone for joining us. One thing I wanted to mention is that we have all of our previous webinars located on our learning center, which is bautisfinancial.com/learning center. We also have a schedule of upcoming ones. And just to note, our next one is on long-term care planning on April 7th. So if anyone has any questions specific to their situation and what they should do with an old retirement account, I'd be happy to talk, or you can schedule an appointment from our website, bautisfinancial.com/call.